Our next guest says the debate over too big to fail has become too hard to follow. We are joined right now by Roy Smith. He is a finance professor at NYU's Stern School of Business. He is a former partner at Goldman Sachs and author of Paper Fortunes, an 80-year history of Wall Street. It hit bookshelves last week.
And in his column on Bloomberg today, Roy addresses the steps that Wall Street and Washington need to take to avoid future financial meltdowns. And Roy, you are effectively dissecting the Volcker Rule, as it were. And I have to say, to your credit, this really is among the most clearly reasoned critiques of Volcker's plan that I've read thus far. If I get this straight, you say that Paul Volcker's intent is on target, but the language effectively is imprecise and the scope is too narrow. Am I correct?
Well, certainly the language is imprecise, and there's always the devil's in the details of these things. The issue seems to be whether or not restricting proprietary trading is a meaningless thing or not, because several people in the industry have said they don't do much of it, and in any event, it's all client-driven, so this is all sort of irrelevant. That really isn't the case if you go back and look at the history of our recent meltdown, when we had all these fantastic losses taking place at Bear Stearns, at Lehman Brothers, at Merrill Lynch, at UBS, and Citigroup, all of whom were related to proprietary investments, if not trading. Look, they had mortgages on the balance sheet. They had real estate on the balance sheet. Lehman Brothers had bought all this commercial real estate beforehand. Those are investments that had nothing to do with serving clients. They were there because the bank put them there on purpose in order to make some kind of money on the carry trade.
I mean, one of the larger or louder arguments we've heard against the Volcker Rule is that prop trading was not a cause of the financial crisis.
Well, this is the point. Prop investing, which maybe was the consequence of prop trading, was the problem, because they ended up with all these assets on the balance sheet, which, when the market started to melt down, were the cause of the great big write-offs. So, you know, all of these write-offs that we had, which of course got everything going, was because of these assets that they had on the books, not things that were put on there in order to serve some client someplace. So Volcker's trying to say, look, these are not things that banks, which have the implicit guarantee of the government or the taxpayer, should be doing. Now, if we recognize we've had two big crises, financial crises within 10 years, and we worry about another one coming in the future, the regulators are telling us, including Geithner and the rest, that don't worry, we're not going to restrict how big they are or what they do, but our regulators are going to be so good that they'll get it right.
Which seems improbable.
Well, which has never happened in the past, and never. And it certainly didn't happen in this last time. It's the same people that are going to get the regulatory authorities. Volcker's really saying, look, take the meat axe and chop off some of this stuff that's really unnecessary for the banks to do to be banks, and we will limit the size of the safety net in doing so, and we will make fewer banks too big to fail, and the ones that remain in that category will have to have the ropes tightened on them so they don't do so.
Now, we do want to get to a solution that you propose, because it is similar in intent to the Volcker Rule, but would take a different approach. Right. Fill us in.
Well, there are two things that have to be done when you get to this stage. One is that you have to fix the banks inside the safety net so they don't fail again. And one way to do that is to provide incentives, such as the Volcker Rule, which is a negative incentive, but also other ways to get these banks to decide to break themselves up into more manageable pieces.
To get rid of that part of the business.
Well, take all the stuff that really belongs in the hedge fund world and put it there, and shrink the remaining bank. And when you do that, those assets covered by the bank in the banking part will be assets that have to be covered by higher cost of capital anyway. So it's not doing the hedge fund part a favor to have them be suffered with a higher cost of capital. So this would be a natural way to break it up. But what we really need to do in the end is to keep the burden of the future rescues, 10 years from now, whatever, off the back of the taxpayer.
Okay.
And we do that by having a depository insurance program.